Hi, my name's Kurt. I'm a value investor, and in this video, I'm going to be covering Ulta Beauty stock, their valuation, discounted cash flow. The real question we're going to answer today is what is the value, the intrinsic fair value of Ulta's stock? How much should we pay for it today? And is it a good investment? Is the business fundamentally sound? Is it something we want to be invested in? So we're going to look into all that, do a basic overview of the stock. We're going to look at the financials, the numbers, the balance sheet, and all that information with a discounted cash flow analysis result. What's the fair value of the company? What's the expected return at the current price? So if you get any enjoyment and value out of these videos, please like the video and make sure you're subscribed. And so with that, let's sit down and look at Ulta. Okay, let's get into our stock analysis for Ulta Beauty and the discounted cash flow valuation results. This is just a little breakdown of what I'll be covering in the video, main takeaways, principles of valuation as a reminder for any new viewers. We'll go over the business overview quickly, then the trends in the financials, the balance sheet, the fundamental pillars, and finally we'll get to the results so you guys can see what is this company worth according to my model, and a quick summary at the end. So with that, first of all, main takeaways, Ulta has an okay expected return. I say okay because it's really between 10 and 15%. You're going to see exactly what that percent is in a little bit later in the video. But I think right now, given the current price, Ulta has I would say like a good or okay expected return. It's not that bad. Now, also the company has great fundamentals, and we're going to say great. We're going to see it meets 8 of the 8 fundamental pillars. And so that is really good. Ulta, it has a really sound business. All their financials and the trends are all like super thumbs up. So, okay, we have something brewing here. And the last thing I want to talk about is just that the brand moat of Ulta. And we'll show a little bit of the video of the CEO talking about the company and what's happening. But I think this is a company with a great moat. And great moat companies are really good because when you invest in those, it makes it more certain that, okay, nothing super crazy is going to happen. The business is not going to be drastically impacted by any sort of economic factors. It could be impacted, of course, but it's going to be one of the less impacted industries, not like some of the big cyclical businesses or financials or anything that would be drastically impacted by a recession. So we have a company that it's pretty steady. It's going to be around in slow times and good times. It has great fundamentals, historically doing well, and okay expected return. It's on the good side. So all in all, it's looking very good of an investment. But let's take a look into the details of the company. Before we get into the valuation and all that stuff, let's talk just briefly about my principles of valuation. The biggest thing when it comes to valuation is free cash flow. You could look at earnings as well, but the cash flow, the free cash flow is the cash from operations minus the capital expenses. Remember, those capital expenses are yearly expenditures required to maintain the assets of the company into good, state of good repair. So if it has a factory, if we have a factory, we need to take into account the money we spend every year to keep that factory, replace parts or whatever it needs to keep that the capital in good working order. So free cash flow is really, okay, we have all the money left at the end of the day. We pay everything to keep the business standing as it is, and that is our free cash flow. It's basically the money left over at the end of the day after all bills are paid. We also look at a per share basis because we don't want to look at companies that are diluting the shareholders. They may be growing free cash flow 10% year over year, but their shares are growing 20% year over year. We're getting killed if we own that company. We're getting diluted. So we're always looking at the shares outstanding. And then once we project the free cash flow into the future, always when we look at future earnings, we have to discount them to what is that equivalent value today? Yeah, it's going to make $50 a year in the future, but should I pay $10 today for $50 in the future? Should I pay $20 today for $50 in the future? We have a discounted model, and we tend to center around that 10, 15, and 20% return targets, and that's where we use the discount rate. So we're discounting the future back to today's value, so I can tell you today it's worth this much per share. And last but not least, we look at the pillars of the company. We have a pillar system that assesses the predictability, the quality of the business, the balance sheet, how healthy the company is overall. If it's looking better, then we feel a lot more comfortable investing in it for good value. Now, what kind of a company is Ulta? Well, they sell makeup, cosmetic products, also skincare, fragrance, hair care. So that sort of space, it's something that a lot of people spend money on, recurring basis, makeup, obviously, that kind of thing. That's what Ulta sells. But the interesting thing that I found about this from a business perspective is that they have diverse prices and they have a diverse portfolio of brands that some are high end, some are more budget items. So people across socioeconomic status are buying Ulta's products. They have those high end. If you want to go in and get a present for somebody or make like feel really good, or if you just want to get stuff for everyday use, Ulta has it. They've combined everything under their company. They have different brands that appeal to different types of customers. The company has a current market cap of 19 billion, has a price to earnings ratio around 16, which is pretty good for a growing company like them, and the dividend yield, they do pay a dividend, is about 2.4% from the current price. I always love to look at the management, and it's interesting to note that their CEO, Dave Kimball, took over as CEO in about mid last year, I think June of 2022. So that's an interesting thing to see. I think there was a woman that was the CEO before him, and she oversaw Ulta with having a huge explosive growth period. So here's Dave Kimball. He's taken over, and I like to look into the CEO. What do we know about him? Do we have confidence when, let's look up a YouTube video. Let's see some videos of him talking about the company. Does he instill confidence that he knows how to run this company well? Well, let's listen to a video of him talking at an event back in April of 2023 this year. And just a couple things he says. This is a 20-minute long video or something like that, but I'm going to just play a quick section.
What do you see coming next in 3 years, 5 years? It's interesting you mentioned robots applying. Do they actually apply the lash, or how does that work?
That's the idea. It's a technology that can help really simplify and streamline that process.
Wow, it's interesting to think about all these new things that could be coming. So where do you see Ulta going, but also the whole category going over, let's say, 3 years?
Well, I mean, like a lot of things, I mean, I obviously don't have a great track record in predicting exactly. I wouldn't have predicted what happened over the last 3 years. So I know there'll be a lot of change and a lot of unpredicted dynamics that I think will actually probably end up being positive. But a few things I guess I'd point out that I think will fuel the category, and some of these by extension broader retail. The continued expanded definition of beauty, the idea that beauty is connected to wellness, will continue to grow. It'll lead to new products, new experiences. It'll influence the existing categories like makeup and skincare, hair care, fragrance. It'll introduce and create new categories in wellness. It'll allow us to expand our assortment as we've done. And so we think that'll be a big driver for the total category and an area of growth opportunity for Ulta, and in many ways we're just getting started on that. I think this connection between physical and digital, of course, I mean, this conference in a lot of ways is about that, but we've come a long way, and we've built some real capabilities, but many of them are kind of basic. I mean, buy online, pick up in store, we're really glad to have it, but there's more coming that can take what is the heart of our company and add digital and technology experiences that serve our guests outside a store, but also serve them in store, and just make it as seamless as possible. And some of those examples I talked about will be driving that. I think personalization and loyalty is a big focus for us. We have 40 million members of our loyalty program, 95% of our sales, innovating, personalizing that. And then just continued innovation. Those entrepreneurs I talked about will drive this category and have throughout history. And I know many of them now that I'm already aware of, and I know in the next 3 years there's going to be many more that will help define the future of beauty, and we're excited to be a big part of it.
So, I mean, there's more he says there, but I think the big I mean, there's a couple big themes he talked about. Beauty as a part of wellness. That's a big trend. I mean, people want to feel healthy and well, and they'll sacrifice at this point. I think culture's moving that way for some reason. Like, people are willing to sacrifice a lot to feel complete and whole and well. And if they can tie in, okay, skincare and all this stuff, you're also being healthier. Well, we'll see how that goes. I mean, he's an advocate for the industry, so he's talking about things that are pretty impactful, pretty important. So does he know the company? I mean, that's for us to judge, but it's like at least a good practice to listen to the guy speak and to maybe know what's going on with the management. That's why I always throw this slide in there. Now let's look at the numbers. This is the price history of this stock. And you can see, okay, overall, very positive trajectory. It doesn't have a cyclical thing where, oh yeah, like 15 years ago it was more, it was a higher price than it is today. No, it has this positive R squared function. The trend line, the differential from the trend line is 0.92, so that's very high. That means it follows a very steady trajectory. It's not very fluctuant. But there have been fluctuations, obviously, and right now we're in the middle of a very steep drop-off in price. So this might be an opportunity to jump in at a slightly below trend line and get in if we like this company. So take a look at it. Everything's looking pretty good so far. So let's look at their revenue. They did have the COVID decline and they quickly resumed. Now you can see that the growth, maybe you can see it a little bit, is starting to slow down. Like if we see these last few data points, the slope is starting to narrow out. So where do they end up in perpetuity? What's the future looking like? Well, they're still growing, obviously. So we can look at over the past 3 years, the annual growth rate, the annualized growth rate is 15% per year. 5 years, 16, and 10 years, 16. That's pretty steady for the revenue side. Now, how does that translate into income, net income, or profit? Of course, the dip was bigger because of the revenue decline. Net income really sharply fell and really sharply recovered. Now we're sitting, look, I mean, 1.2 billion in profit. This is a 12-month rolling average. But look, before COVID, I mean, it was down at 700 or something like that. So not quite double, but it's come a long way. It's starting to level out. Again, what's the future? I don't know. But 10-year growth, 21% per year. So, and it's only been higher in the last 3 years, obviously, because of the pandemic situation. Now let's look at free cash flow. In the black line, the darker line, I have trailing 1 year free cash flow. And then in the green line, I smooth it a little bit by adding a trailing 2 year annualized free cash flow. So it's an equivalent basis, but it's rolling with a smoother line there. And okay, we had, I think it was 16% revenue. We had something more like 21% for profit, 30% annualized growth over the last 10 years in free cash flow. That is really heavy growth. And I see this positive growth rate continuing into the future. I mean, you can see it is slowing down a little bit. You can look at the chart and say, maybe the growth is slowing a little bit, but I think that this company still has a lot of potential to move forward in the positive direction. Maybe it won't be 30% per year. So let's look at that when we do our discounted cash flow analysis. I'll tell you the assumptions that I ended up using. We also look at shares outstanding, like I said before. They are down 2.4% per year in shares outstanding over the last 10 years. They have this really robust share buyback program. That's a lot for a company. 2.4% per year for 10 years. And in the last 3 years, it's down even more, 3.7, almost 4% per year. Now, that's a good thing. Decreasing shares outstanding helps current investors gain a bigger share of the pie. And so the returns go back to the shareholder if the company is buying back these shares at a cheap valuation, which you could argue that right now is the company is a decent valuation. We'll get to that in a second. So that's just something to keep your eye on. Now, when we combine the shares outstanding with the profits, we get the per share earnings. In the green line is the per share free cash flow. Pink line is the profit or earnings per share. And so you can see very similar trajectories, but the difference here is that the free cash flow has benefited more than net income. You could kind of ask questions of why that is, but it's good to see that generally they follow the same pattern. And that's 33% annual growth historically over the last 10 years. And when you look at it, profit, it's just below 20% per year. Those are fantastic numbers. They've been a little different when you look at shorter time windows. And again, very steady other than the COVID interruption. And again, this leveling off trend, but that's on the per share basis. It looks really good because they've been increasing their profits, but also buying back shares. It sort of compounds in a powerful way. Return on invested capital tells us how good is this company at taking the money they have and investing it and then growing their business. Anything above 10% return on invested capital, we consider like that's good. It's good for a company to have greater than 10%. That's where I draw that solid line. The purple line, you can see it's usually above 15%, and right now it's above 20%. So that's pretty good, and it's actually slightly increased over the last 10 years in a pretty steady upward direction, other than, again, the pandemic interruption. Let's look at their balance sheet. We see they have $5.2 billion in total assets. They have $3.2 billion in total liabilities. So looks okay. I mean, they have almost $400 million in cash on hand. I don't really like the $1.1 billion in property, plant, and equipment. And they also do have a lot of inventory, which I don't show here as part of their assets. So what I do is I derive their quality, what I call their net quality assets, where I adjust their assets. Like I remove a little bit of their intangibles, which they don't have a lot of. In fact, I love that. Only 12 million showing on the balance sheet for intangibles, but I remove some of the intangibles, property, plant, and equipment, and inventory, just in case they need to sell inventory at below price. And that's what I reduce their total assets to, and then I subtract their liability. So net quality assets is 1.2, 1.3 billion, and on a per share basis, that's $26 about. So when you're buying the company, you're buying the balance sheet as well, and we have to add that per share. We have to add that per share value onto our discounted free cash flow valuation or analysis. So that's the balance sheet. The pillars look very good for Ulta. They have 8 out of 8 sub pillars, and you can see that actually almost all of these X's or red boxes where they didn't meet the criteria for the sub pillar, almost all of them are just on the line. I mean, 23.5 PE ratio, and we want it to be less than 21.5. It's very close, and that could just as easily be a green check mark. It's very close to being a green check mark. Same thing down here. We want 4 out of the last 5 years positive net income. It's been 3 out of the last 5 years. So, okay, take away COVID and we have something good there. The debt is the one thing. Cash on hand I wish was a little bit bigger compared to their current liabilities, but it's 26% rather than the 33% we prefer. And last but not least, the free cash flow valuation is very similar to the PE ratio. And so it's so close that I'm going to say the equivalent of about 18 sub-pillars are checked. You could make an argument for 19 or something like that, but in reality, it's only 17. But I'm saying 8 pillars and 18 about sub-pillars are check marked, and that means that this company is extremely fundamentally sound. That's really good to see. So let's look at the valuation. Here's my forecast. Right here, 15% per year in the next 5 years growth in free cash flow. After that, I forecast 8% per year, and I think that's very conservative. I put the terminal growth rate after 15 years at 2% per year. And I also put in a per share reduction of like 1.5 or 2% because they've been doing that so well. I might have put the terminal rate of that at 1% per year. So I think those are pretty conservative assumptions, and you can see that after all of that, when we use our 10, 15, and 20% discount rate scenarios, on average, I have a fair value of $415 a share. But that's a little deceptive because it's a very wide range between if you use a 20% discount rate or 10% discount rate. Totally different values. I'll show you in a second. I think the 13% expected return at the current price is the more accurate way to summarize the valuation of this company. 13%, and that's including a 20% margin of safety. So these bullet points outline that. I used a 20% margin of safety. I usually use 30%, but this company is so fundamentally sound and so well predictable that I thought 20% was fair. I used that 10 to 20% discount range, and that gave me a fair value between like $215 a share and $700 a share on the high end when I use the 10% discount rate. So it's like the 20% discount rate yielded $215 a share. The 10% discount rate gave us $700 a share. So wide range. 415 was in the middle. But all things considered, we should expect about a 13% return if we bought at the current price, in a 13% return into the future. So my summary for Ulta Beauty is just that. Great fundamental company. we should definitely want to own this company. It's just a matter of what price you're willing to pay for it. I mean, this should be on your radar. You should have your own price target and constantly be looking at it. And then when it gets low enough, buy. And that might be right now because, again, the prices come down. It's a pretty fair valuation, which is my second point. Fair value of $415 a share. And I think it's right now about $380 a share. So if you're in that position where you're saying, look, I don't need a 30% return rate. I don't want to be super aggressive. I want something that's fundamentally sound to add some quality to my portfolio. I'm okay with the 13%, somewhere in that 10 to 15% range. I think this is a good option for you. It's not going to hit a grand slam at the current price, but at least I don't think it will. But it will deliver probably a good return that's going to be better than the market maybe, and it's one of those quality, fundamentally sound investments. Therefore, when I combine the value ratio, the expected return, the business pillars, I come out with a very good recommendation. It's 8 out of 10 for me. That's a combination. In order to get 8 out of 10, by the way, that's like in the top 10% of all the stocks that I've evaluated to this point. So to get an 8 out of 10, you need to have a good mixture of very sound fundamentals and pretty good valuation, like pretty good value to price ratio. So thank you for watching. If this video has been helpful to you, please like the video, and you can comment down below what stock would you like to see me cover next and do an analysis on. This stock was actually in the comments section of one of my previous videos, and I had been looking at it personally, so that's why I decided to do a video on it. So if you leave a comment, I might end up doing a video on it. So take care, everyone, and best of luck investing. Bye.